This video is about the critical importance of a quality of earnings report in gauging the quality of the accounting of your company, whether you're going through an M&A transaction or raising capital for growth or just renewing your loans and lines of credit in general. Having a third-party accounting firm come in and review the quality of the accounting. Okay, you're a business owner. You've spent maybe decades, a long time investing in your business and developing things. You know your business inside and out, but people outside the company just don't. And the main way that they get to know your company is through the numbers. And when you go to raise capital or you're doing an M&A transaction, you're going to be talking to professionals who were trained in accounting and finance. And in those disciplines, the numbers are everything, okay? And so your story is really important, and they do want to believe in your growth story, but ultimately, if they're gonna make a decision to actually give you money, to lend you money, to invest money in your business, they're gonna have to check the numbers. And the way that they're gonna do that is they're gonna hire a third party, an accounting firm, to come in and verify everything that you've told them, okay? Trust but verify. They are not going to give you $1 until they verify through some type of third party exactly what you've told them. And so that's the critical importance of a quality of earnings report. Okay, you've spent decades building your business. You know it inside and out. You know that you have confidence that your customers are not going anywhere and that your revenue is going to be at a certain level. And of course, you believe strongly and you're heavily invested in that, okay? But they're not. And they are reviewing hundreds of other transactions. And ultimately, the one way that you can set yourself apart is through the quality of accounting, okay? Generally, companies that we work with are anywhere from 10 to a few hundred million in revenue. And those companies have a lot of similarities. And one of them that is very common is the evolution of their accounting practices from being a small business to a middle-sized business and beyond. It is hard for businesses in that range to hire experienced full-time CFOs that make hundreds of thousands of dollars a year. So generally, their accounting is not quite to the level of like a publicly traded company or a large corporation. It's slightly below that. Doesn't mean it's bad, it's just the way it is. And so especially companies like that in that range, anybody that is lending you money, anybody that is investing you, any institution that's going to invest money, real money into your business, is going to put your company and your accounting through some type of verification process. The standard is a quality of earnings report. So wanted to talk about that today. I've been through hundreds of transactions in the middle market as a lender and with private equity firms and with mezzanine debt firms and SBICs, SBA loans. It's all the same. Ultimately, it's going to come down to some outside accounting firm, another set of eyes coming into your company and verifying your books and records and the quality. And they're going to make an assessment. They're going to give you a grade. You will be graded, okay? And look, it's a little bit more than just pass, fail, but you can fail. But more importantly, the grade that you get is going to absolutely have a direct impact on how much money you get, the interest rate you have to pay, the type and structure of debt, how fast you have to repay it, and how likely they are to support your business and your growth objectives. So that's what I wanted to talk about today. What is a quality of earnings report? Let's just start with the basics. This term gets thrown around a lot, and sometimes even sophisticated operators confuse it with an audit. They're not the same thing. A quality of earnings report is a third-party accounting analysis, typically performed by a CPA firm that specializes in this. Now, that CPA firm also may do audits, but this is a different department. This is a separate department that just focuses on quality of earnings report. It's not just whether the numbers add up, it's whether the earnings are real, repeatable, recurring, representative of what the business actually generates. So if you say that your business generates $5 million of EBITDA, is that true? Is that accurate? Is that repeatable? Is that recurring? Or was it somehow based on some one-time event or one customer? Is there customer concentration? Is the earnings and the EBITDA margin consistent and level? Or does it bounce around a lot? And why does it bounce around a lot? And so you're going to be asked these questions, and then whatever answers that you give, they're going to be verified during this quality of earnings report process. So an audit confirms the financial statements as presented, in accordance with generally accepted accounting principles. It's really a compliance exercise. A quality of earnings report is a little different, okay? If you've been around the middle market for a little while, you know that EBITDA, or earnings before interest, taxes, depreciation, and amortization, it's a primary valuation metric. It's a primary metric that's used for covenants, financial covenants, credit metrics, purchase price multiples. It really drives everything. But raw EBITDA, right off of a P&L, is almost never the number that actually gets used in the transaction. Typically, there is some kind of an adjusted EBITDA number that is calculated through the QOV process. And so if you say, well, there were one-time expenses that happened last year, those should be counted as an adjustment and counted as adjusted EBITDA, that's going to be checked. That's going to be checked and rechecked. So, example, a seller might say our EBITDA is $4.5 million, but what does that actually mean? Are there one-time expenses? Is the owner paying themselves, below market compensation? Or conversely, are they taking a bunch of distributions for taxes? All these things affect the real earning power, the recurring earning power of the business. So in most cases, the QOV report is going to be ordered by the outside investing firm or the outside lender. And most of the time, industry practice is that the company or the borrower is going to pay for that. So you can get what's called a sell-side QOV, which would mean that the company, in advance of raising capital or in advance of selling their company, goes out and pays for a quality of earnings report before they start the process. But whether you do that or not, there's most likely going to be an additional QOV ordered by the lender or the investor or the buyout firm that is going to be investing money into the company. So the typical QOV is performed over a course of 4 weeks, sometimes 6 weeks. It involves direct access to the company's controller, chief financial officer, books and records, CEO, management. They're going to be interviewed. They're also going to review a number of your customer contracts or paperwork, assuming that all companies have paperwork that verifies and backs up whatever customer contracts or customer relationships that you have. They're going to review revenue schedules, cost schedules, probably your payroll reports, probably any type of systems that are involved, potentially your CRM system. The deliverable after this 4 to 6 weeks is a written report. That's what the actual quality of earnings report is. It's usually 30 to 100 pages. It's got schedules. It's got EBITDA bridges. It has all kinds of analysis, but most importantly, as a clear statement of what this accounting firm believes is the adjusted EBITDA and most likely the adjusted net working capital, which are both key figures that are going to be factored into the purchase price or how much you can borrow from a lender. And that document, that quality of earnings report, is going to become the foundation for every negotiation that follows. Enterprise value, purchase price, leverage multiples, debt capacity, earnout structures, all of it flows from what that Q of E report establishes. Is going to be referenced for years to come. All right, so why does this matter in M&A transactions? Well, when a financial buyer or a strategic acquirer is evaluating your business, they're paying a multiple of EBITDA. Okay, so depending on the sector or the business quality, it could be anywhere from 4 times to 8 times or even more for a good quality company. And that multiple is a multiple of EBITDA. So if there's a $500,000 swing in EBITDA, this could be $2 to $5 million of value or capacity for debt or leverage. So the adjustments, whatever they are, whether they're accepted or not accepted, are critical and incredibly important to the purchase price and to the value. Revenue quality. So are revenues booked on an appropriate basis? Is the revenue recognized appropriately and in line with what you have told the potential investor or the lender? Are there concentration issues? 1 or 2 customers making up more than 30, 40, 50% of revenue. Again, this is not uncommon, and these lenders and investors are pretty used to this stuff, but those types of customer concentration issues directly affect how much you can borrow, whether or not they're going to lend you money at all, how much your business is going to sell for, or whether someone is even going to bid on your business. This is incredibly important because one customer that's 30, 40% of revenue that goes away, that could mean almost all the value of your business is gone. It could be a dramatic change in your borrowing capacity. So the Q of E process gives buyers and their advisors the comfort that this revenue is recognized properly and that their customer concentration issues are understood, okay? They still might be there, but they want to understand them and be crystal clear about them. Remember, whoever you're talking to, investor, lender, they have to go back to all their peers and coworkers and colleagues and bosses and convince them to do your deal, okay? To convince them that your deal is the one that they want to do over the 25 other deals that they're going to see this month. The 200, 300 deals they're going to see this year, yours is one of the 3 or 4 that they actually want to do, okay? So the bar's high, and the quality of the earnings and the quality of the accounting and the quality of the revenue recognition are critical. Your accounting policies, okay? They're going to review your accounting policies. How do you handle inventory? How are customer deposits treated? Is there uniformity across the board? Do you make special considerations for certain customers? Those customers that you maybe have concentration with, that largest customer that's 25% of your revenue, do you make special compensation for them? Do you give them discounts? Do you give them special treatment? Do you let them pay slowly? Do you maybe give them better pricing? All these things are going to come out, okay? You might as well be upfront and honest about them because they're going to come out in the due diligence. One that's maybe most surprising to sellers that comes up in quality of earnings report is a working capital analysis, okay? The Q of E team is going to analyze normalized net working capital, accounts receivable, inventory, accounts payable. How are you making payments? How do you pay your vendors? Some companies pay their vendors too quickly. Some pay them too slowly. Some are all over the map. Okay, middle market companies, it's pretty common that there's a lack of uniformity, and they pivot from time to time and make different adjustments. Seasonality. Sometimes business owners are surprised to find that there's maybe more seasonality than they realized, or they don't really talk about the seasonality even though they know it exists, and then it comes out in the quality of earnings report. There's certain months during the year where you're really strapped for cash, and that happens every year, okay? They're going to find out about that. They have to find out about that before they close the deal, before they lend you $1. So that's really important. Off-balance sheet items and contingent liabilities. Same thing. They're going to find out. Are there lawsuits? Are there judgments? Is there pending litigation? Is there deferred revenue? Are there customer deposits, large customer deposits, prepaid insurance, environmental exposure, past liabilities, long-term liabilities? These things are going to come out. Deferred rent. The Q of E is going to help surface all these items. All right. So here's what I want you to understand most importantly. If you're a business owner preparing for a sale, if you are a business owner, CFO, who's preparing to go raise capital, the Q of E is not just a check the box exercise. When a buyer's Q of E firm comes in and identifies $400,000 adjustment, or they don't buy off on an adjustment, you can have a chance to have your day in court to negotiate that. So this document is negotiable. Doesn't mean you're going to win. Most likely, there's going to be 7 or 8 or 10 points of contention, and you want to go through and negotiate all of them. You're probably going to end up winning some, and then some you're going to have to give on. That's just part of it. But I just want to make sure that this quality of earnings report process is active and it's iterative, and you can negotiate some of these points. So shift gears real quick and talk about the debt side. So leverage buyouts, dividend recaps. Obviously, it's the same process and the same critical nature of the EBITDA, adjusted EBITDA that comes out of the Q of E process. So just know that it's a very similar process, and that multiple of EBITDA is critical. How much you can borrow. Let's say they're probably willing to lend you maybe 3 times that EBITDA. Well, if your adjusted EBITDA ends up being $6 million versus $5 million, that's $3 million more that you can borrow. So critical. And then all the other factors, the quality of your accounting, the quality of your revenue, the quality of your revenue recognition, the lack of customer concentration or the presence of customer concentration is going to affect the interest rate and how quickly they want you to repay the debt. So last thing I'll just touch on real quick, special situations and distressed credits. Same process, even if your EBITDA is down, if it's gone from 8 to 5 million, same things they're going to check. They're going to check the quality of the earnings, why has it gone down, and then detailed analysis of the margins and the consistency or sustainability of the margins. Where does it look like the normalized level of margins is for your business? So hope this helps. Again, we're always available for tips. If you could do me a favor and like and subscribe this video for more content like this. Having been a veteran of leverage finance and commercial banking and investment banking for over 30 years, this is incredibly important. These quality of earnings reports, they aren't going anywhere. This is the industry standard. Nothing with technology or AI is going to change this. They need to verify the integrity and the veracity of your accounting and the quality of your stated earnings and whether or not it's repeatable and recurring. And it can be pass-fail, but generally it's somewhere more in the grading. You're going to get an ABC grade. If you get below a C, you fail, but you're going to get an ABC rating, and it's going to directly affect how much you can borrow, how much your company sells for, and how good those terms are that you're able to borrow or sell your business.